Good afternoon, everyone. I am Doug Cha, the Executive Director of the Governance Center here at the Conference Board. Welcome to today's book discussion webcast. Very pleased today to be joined by author Jeff Gramm, founder and managing partner at Bandera Partners, a hedge fund here in New York. And today we'll be talking about his book, Dear Chairman, Boardroom Battles and the Rise of Shareholder Activism, which has received a lot of attention from the governance and investor community. And so we're looking forward to hearing about his work and the history of shareholder activism and some of the key takeaways for directors, investors, and managers. Before I begin, a couple housekeeping notes to cover. We welcome the audience to participate in today's session. You're welcome to ask questions by entering them in the box at the bottom of your screen, and we'll see them and we'll try to work them into the conversation as things go along. You can enlarge the video to full screen by clicking on the 4 arrows in the upper right-hand corner of your screen. Please complete the evaluation at the end so we can get your suggestions for future webcasts and your feedback on this one. You will be able to share the program with your colleagues after the fact. We will post it for replay on our website. And so without further ado, let's get started. So let me just introduce Jeff a little bit. Jeff is founder and managing partner at Bandera Partners, a hedge fund here in New York City. He's also an associate professor of value investing at Columbia Business School. His book has received a lot of attention from the investor and governance community, and in fact was ranked one of the books of the year in 2016 by the Financial Times. It's earned praise from Charles Schwab, Warren Buffett, Alan Greenspan, Arthur Levitt, among others. Early in his career, Jeff actually started as a professional musician before heading to business school.
Professional.
And there he took on a hedge fund. From there, he took on a hedge fund manager role, first at a fund owned by BNY Mellon, then at Arklow Capital, before founding his own at Bandera in 2006. So, Jeff, thanks so much for joining us. It's great to have you here. Why don't you just tell us a little bit about your background
Sure.
before we get started?
Sure. So I did play music, but on the side I temped. So I was a professional temp.
You were the starving musician in New York. Yep.
Yeah. But I went to business school in 2001, and that was kind of like the Wild West for the hedge fund world at that time.
Sure.
So I got an internship at a little hedge fund called HBV, and around the time that I was interning, it got bought by Mellon Bank, and I began there full time in 2003. So I worked on the distress fund there. The fund got up to about $1.3 billion, which at the time was, kind of a bigger fund. And from there, my boss at the time and I launched a little distress fund called Arklow Capital. And from Arklow, I launched Bandera with a partner.
Gotcha.
Greg Belinsky in 2006. So we've been in business for 12 years, which feels like an accomplishment in the hedge fund world.
Sure. So let's talk a little bit about the book. What prompted you to write this book?
I really always have enjoyed writing. I did feel like I had a decent writing chops, and I thought at some point I would like to write a book, like to maybe take a leave from work. I thought it would be like a pop science book or something like that. And I had this idea while teaching of collecting investor letters. I used these investor letters to public companies as a teaching tool in the class I teach at Columbia. And I just thought, well, there must be a compilation of these things out there somewhere. And when there wasn't, I just thought, well, I could do that. And then as I thought about that project, it seemed like a lot more fun to kind of take that idea, but actually turn it into a narrative history.
So, you must have read through tons of these letters, a lot of which were public. And so how did you arrive at kind of the small subset that you you chose for the book.
Yeah, I mean, a lot of it is just like the necessary. I mean, there's like the laziness aspect of it, of like when I first began to conceptualize this book, it was going to be a much broader book. Like it wasn't just going to be, well, necessarily activism, financial activism. Like I was going to talk about, the social activists, like the people who bought shares in Greyhound to try to desegregate the bus line. I was going to do like a whole chapter on the Bill Schlensky Chicago Cubs. And I was going to do more kind of broad business, like the financial crisis. I was going to do, there's a great speech that Wynne Smith, who was a Merrill Lynch employee, gave to the board at the board meeting where they sold the company in the financial crisis. And I was going to do a chapter about that and like necessity, common sense.
Yeah.
We'll narrow that to like, well, what do I know the most about, and how can I make this thing, coherent and readable. So from there, it was like you pretty much go with like that you need to depict like particular eras. Like you have to do the 80s, like you have to do the proxeteers in the 50s.
There's certain kind of must-dos.
Yeah.
Yeah.
Like there's a few that were just, so clearly on their own, historically important, like Ross Perot GM. And then there's a few of the kind of cult of personality. Like you kind of have to do Warren Buffett.
Yeah.
Because like he's Warren Buffett.
Yeah.
So, like the big choices were like the more representative ones. Like which one do you choose of the 2000 activists? Which one do you choose of the 50s proxeteers? Which one do you choose of the corporators? So those became the harder choices.
So I mean, you got a really good cross section of the letters and significant ones throughout the different periods. Just want to talk about one of them, which is the first one, Benjamin Gramm taking on Northern Pipeline, 1927. Which you have, you kind of deemed is the first modern activist situation. Just tell us a little bit about the story there. Sure. and the impact, the lasting significance it's had on activism.
It's a fascinating story. I'll talk about the impact next, because its actual, impact is debatable. But Benjamin Gramm is the father of value investing, like a very famous investor, and he bought a stake in the Northern Pipeline Company pretty early in his career. He began on Wall Street in 1914. This was the mid-1920s. And Northern Pipeline had been a part of the Rockefeller Standard Oil empire. And when that was broken apart by the government, there were a handful of these pipeline companies that were created, and they became independent, publicly traded companies where the Rockefellers held a large stake, but not a controlling stake, and they generally controlled the boards. And Ben Gramm figured out that the ICC, which publishes a report on the railroads, actually published financial statistics on the pipelines. And he went down to Washington, D.C., and requested the ICC's report on the pipelines, and he found all of their financial statements, and lo and behold, Northern Pipeline, which was trading at $65 a share, had over $90 a share in liquid, gold-plated bonds. And Ben Gramm was like, well, this doesn't make any sense. Like, they don't need to reinvest this capital into the business. They should just distribute these bonds to shareholders. It'll be a win-win for everyone. And he thought that would be easy to accomplish. And when he approached the management team to do it, it turned out to be extremely difficult. And he ultimately embarked on a proxy contest, and he had to lobby the Rockefellers. And in the book, it's a great example of a campaign. It's a great example of how activism works, and it's a good place to begin because in terms of evaluation, when you talk theoretically about an undervalued company, there's no easier way to conceptualize that than they have a bank account that they don't need to run their business, that's worth more than their business. But in terms of its importance, you could argue that yes, it was a very early example of a financial activist. I mean, of a fiduciary investor, like performing activism. Brian Sheffens, who I think that you're going to have on as a guest in the fall, did some research on fiduciary activists or financial activists in the early 20th century, and there basically were none. There were like a tiny handful of cases between 1900 and 1950, and Ben Gramm was among the first, if not the first. But he had a tremendous impact as an investor. He had an impact from being the teacher of Warren Buffett. The actual activism in that case was not covered in any of the newspapers. Like, it didn't even make it into Brian's paper because it wasn't in the Wall Street Journal. So it's like a useful, launching point for the book. Like, in terms of impact on activism as we know it and the birth of an activism movement, that was probably more born in the 1940s and the 1950s with Robert R. Young, who's the next chapter in the Proxiteer movement.
But so I guess for Benjamin Gramm, it's here's one of the kind of fathers of value investing, and he kind of begat Warren Buffett, and
he very much, activism was a core part of his strategy.
And the thesis is pretty simple. It's just the company's got a whole pile of cash, and what do you, if you're not doing anything with it, then, and so we see a lot of that today, as opposed to something more complicated like break up the company or spin off a business. So I think it is a good kind of a start to the book. So we won't go through all the letters, but you talk about the Ross Perot situation and R.P. Scher, and some of these really interesting cases that there's a lot of personal stuff mixed in there too. You talk a lot about Ross Perot's background, which not a lot of people know the president running for president.
The whole GM case, just like the one thing that when I began the book that I didn't realize just how GM kind of touches on everything. The pension fund, as we know it, investing-wise today, is a product of GM. Professional, management, to a large degree, comes out of GM. Peter Drucker, learned about this from looking at GM. It's interesting how it, kind of all ties together.
Yeah.
And the book is ultimately, it's yes, it's about activism. And activism is a little bit the backdrop, but I tried to use activism to kind of explain how public companies, work, and to kind of write a broader business history.
Yeah. So it definitely traces business throughout American history, and so it's got a lot of kind of ties to what's going on in the country, which is fascinating. I think there are common threads that you find throughout the book. But so you talk a lot about the situations where it's kind of there's an investor and David versus Goliath type thing, and they ultimately are successful in agitating for change and tossing out bad managers and directors. You do talk a little bit about
sometimes good managers and directors.
Yes.
Too.
So, but you do talk about some cases of activism gone awry.
Yeah.
And there's one case that everybody, recent case that people point to, which is Bill Ackman's venture and journey with JCPenney. But you say that's the Ackman thing in JCPenney is not necessarily an example of quote unquote bad activism, even though a lot of people point to it as here's an example of bad activism.
Yeah.
So how do you explain that one?
Well, first of all, the chapter of activism gone wrong. I picked this case BKF, where it was a money manager that gets attacked by a bunch of other money managers who argue that these guys are overpaying themselves, and they ultimately get them booted out, and the assets go from $13 billion to zero. That's a very clear case of the activists. They had the tools, because of the shareholder discontent, to create a tremendous board turnover, and that was disastrous for the business. In the case of Ackman JCPenney, I mean, I think that that ultimately he had this thesis that with with JCPenney, you have these a troubled retailer, but you have these incredibly cheap leases and a lot of owned real estate, and it gives you this flexibility to make a dramatic change. And Ackman he has this particular optimism and belief in dramatic changes, but I think in the case of JCPenney, the market kind of agreed with them. The market and investors were thrilled that he managed to hire the person who was probably, well, not just the highest, profile, but I mean, he was thought of as among the best retail executives out there. And the JCPenney board got Ron Johnson to go from Apple to JCPenney, and I think,
which is basically a huge coup.
I mean, I think that's a tremendous feat.
Yeah.
And shareholders were thrilled about it. The board was completely on board with this, and it was a total disaster, and it completely failed. But to me, is that bad activism? I mean, that's kind of what a board is is tasked with doing. You're tasked with choosing leaders, right? And I think that one thing that we come across in the business world all the time, and as activists, and in the hedge fund world, it's a thing that we just constantly grapple with, is if you have a mature cash generating business, do you go the conservative route, pay out the cash to to shareholders, invest just enough to keep it successful at what they do, but will risk investing in transformative change. I usually opt for that route. Mm-hmm. Here you have a situation where the board, this high profile investor, and it seems like a lot of the shareholder base applauded this other route, which I don't think was a crazy route. And I think lots of people in the business world think more companies ought to do that.
So I guess it's the case of board having a floundering business, and they try to make a bold business decision and bring
invest in that
else.
brand, and it failed.
And business decisions don't always work out.
Yeah.
And so maybe just because Ackman was involved, it becomes kind of oh wow, this is a big activist type thing, which that's largely true. So.
Yeah, and to be clear, I mean, in the context of the book, I was more explaining, look, this should not be the textbook example of bad activism. I'm not saying he's a a brilliant guy and all of his activism is great. And this book in general just explains how activism works. It's not necessarily pro or anti-activism.
Sure.
But I very much was just pointing out, if you would really like a poster child of activism going terribly wrong, when you have sophisticated investors who really knew the situation and they knew the business. These were hedge fund managers that were going after ultimately a big hedge fund. I mean, that was a situation of activism destroying value.
Got it. So in terms of your own experience with activism, you don't characterize yourself as an activist investor, but you were involved in a couple. One was, I guess, your this peerless systems campaign, and you're very self-deprecating here. You say, this was an example of possibly the worst Dear Chairman letter in history, and so. Just talk a little bit about your own experience with activism in the peerless case.
Sure. So my fund is a concentrated value fund. So we'll take 10 to 15 positions in our fund, and they'll be very large as a percentage of our assets. So we probably have 2 positions now that are over 20%. We had a position that was actually 25%. In July, we owned a big stake in Boardwalk Pipeline. Which was bought by Lowe's. And we, when you buy big stakes in companies, you can only do it if the liquidity profile of your investor base allows that to happen, and we're fortunate enough that that is the case for us. But you end up being locked into these positions, and you own them a long time. Like our biggest position, our biggest position we've owned for almost 10 years, no, like for 10 years now. And you ultimately get involved in governance. It's just like when you're investing in small cap companies, even if you're not an activist by nature, just to protect the value in your positions, like the occasional fight happens. And we never buy a stock specifically to activize. Like I'm not that kind of activist. And I think if you have an activism strategy, like as an investor, I think that's the way to do it is like to be an expert in it. And that's not what what we do, but we do serve on boards. Like I've served on either 4 or 5 public company boards, and it's just like it's a necessary tool that you have to have in your kit.
But it's not something you necessarily want to do.
Yeah. So I think the way this began for me is ultimately there were situations where we were kind of used as pawns, by other people on boards who had an agenda, and they saw that that we had a big stake, and then as we've we've done this more, we will kind of take a board seat when an investment has hit the maturity point that we're not going to buy more, but we'd like to be engaged, and we would like to have a seat at the table, specifically to kind of be involved in the capital allocation issues.
And so, from those situations, are there any major takeaways from kind of launching a campaign, being on a board, and trying to agitate or advocate for change?
Yeah, the big takeaway for me is all that stuff is incredibly hard. I'm not a good corporate director. It's a difficult job. I really sympathize with directors. There's always an information imbalance with the management team. It's like you need to kind of understand the financial language of the company, the way that the company analyzes and reports its own internal numbers. There's a real learning curve there. You come in from the outside and you read the 10K and it gives you a picture of this business, but when you invest in public equities, you are operating on limited information. And then when you get in the boardroom, it's not that all of a sudden you're hit with lots of useful information. You're hit with a lot of information that you don't even understand and know how to interpret. So you have to figure all that out. And then I might find it's often a challenge to kind of put the board in a position to kind of have a real discourse with management.
Yeah, one thing we've found throughout our conversations with various stakeholders is kind of what jumps out is what you're calling the imbalance of information. And so, as the investor from the outside, you think the board kind of is omniscient and omnipotent. And once you get there, you realize that's not the case. And but what do you think in terms of how are boards supposed to kind of get on somewhat of an even playing field with management in terms of getting the information they need to do the job that people are expecting them to do?
Yeah, I think that's the biggest challenge, and a real theme of this book is ultimately all of these cases and examples and stories will highlight these aspects of governance that are problematic. And we can learn a little bit through these stories about the nature of how it is problematic, but there aren't lots of easy fixes. One thing that I say over and over again is that the whole idea of best practices for corporate governance is incredibly hard. And there are guys like you that are out there and you're doing it. And as it's a real challenge to address this issue of is there a way to systematically improve governance? And to me it really boils down to the diligence of the individual directors. I do think it's often a better situation when you do have like a CEO that like that has been chosen by the directors as opposed to vice versa. So like in lots of activism, you know, like the activists will come in with like all their like demands, and they can be strategic and they can be capital allocation. But what's often really going on is that they think there needs to be a change in the leadership. Like they never say that we need to fire the CEO like off the bat, or if they do, then it's an unusual situation. Um, but that's often the medium term agenda. And I do think when like the board has as a team, hired the CEO, like it does will kind of change the playing field. And I think just like a lot of these basic things like executive session, like on the boards I'm on, we try to have a regular call outside of the board meetings where like you kind of get your update on the operations. So like you don't waste too much of the board meeting with just like the backward looking update. I mean, you can waste half the meeting on that if you're not careful. And like what the board like is, there to do, like to help with are the forward looking matters.
So maximizing the use of the director's time and making sure it's effective and impactful and not just, okay, let's kind of just walk through the story of the last couple quarters.
Yeah, and that's like the worst thing when you have a board meeting where like you spend half of it on the quarter, and then you get the financial update, and then it's like, okay, now we have to figure out what to do with like this clearly extremely pressing issue. We got 35 minutes.
Yeah, the planes are leaving.
Well, Joe has to get on a plane at 4:30. It's like, and that happens.
Sure, absolutely. So, any interesting trends that you're seeing in activism these days that you think people should really pay attention to?
Sure. I mean, I probably know less about that than the people who are tuned into the webcast and to you, but I guess like the thing that has surprised me is, so this book came out in February 2016, and like I finished it like in February of 2015. So like I wrote the book at 14, 15. And I like at that point in time, like I thought it was like a real turning point for hedge fund activism. Like it felt like the big institutions were getting a little bit tired of their role as the arbiter, but just the arbiter, right? So what had evolved is all this activism is is essentially performed by these hedge fund activists who they may own 5 or 6%, and there's all these big institutions who are kind of like the arbiters, between the management and the activists. Well, sometimes they have played a role in the activists getting involved. Well, sometimes they will have recruited the activists, but the dynamic was ultimately the hedge funds are performing it, and the big institutional passive money are kind of the deciding votes. And it felt like for a while there, you had the proxy access movement. I felt like there was a notion that the big institutions weren't comfortable with just submitting to that role. And in some areas, maybe ESG, they have expanded beyond that to being a little more progressive. But if anything, in the past a few years, we kind of have gone back to where we were before the book came out, with less outward frustration about the hedge fund activists. And if you look at this year so far, there's been more campaigns than ever. You have a few of these will kind of, depending on your perspective, the best in brand or the worst in brand, but the big guys Elliott has done 18 campaigns or something this year, and has put a tremendous amount of capital into these activist deals. And if anything, the dynamic of the hedge funds are the ones doing the activism, and the big passive what people are the arbiters has not really been challenged. And at the time that this came out, it really felt like you saw Larry Fink will complain about this, it felt like, is proxy access, we're going to be the mechanism to kind of institutionalize board nominations.
And it really hasn't.
And it hasn't happened at all. And I think it still might happen. And well, maybe ESG and diversity, could be like a very valuable Trojan horse on that. But you really are seeing like the slates are continuing to be were put up by the hedge funds.
That's interesting. Yeah, and I mean in the book you do talk a bit about the passive investors or so-called passive investors, and also the how shareholder activists kind of woke up some of these folks, and particularly the pension funds like the CalPERS and CalSTRS of the world clearly were woken up by the activists. So, well, let's see. I think it looks like we're just about out of time. So I want to thank you again, Jeff, for being here, and I really encourage everyone to go out and purchase, read this book. It is just it's incredible, almost like a tutorial on shareholder activism, but also corporate governance in general. You have some really good insights. So really, it's a good beach read for the summer. So we're going to wrap up with Jeff. And before we go, just want to announce a few things. We have the Governance Center has some really interesting events coming up in the fall. On September 6th, we have a roundtable in Washington, D.C. with PwC about the job of the corporate director from the accounting world perspective. We have another webcast with Cleary Gottlieb, Governance Watch, coming up on September 18th. And then October 22nd and 23rd, we have our annual meeting of Governance Center members here in New York, and we'll be covering topics like shareholder engagement, board evaluations, and cybersecurity oversight. And these are all for our members, and really encourage you to take a look at those. And so thanks for tuning in to this book author webcast, and we will see you next time.